Hello, this Accounting 2208 Chapter 14 video tutorial will review accounting for bonds using the extra posted problems ABCO and I am finished. The data for this problem is pretty straightforward. Basically, on March 31st, 2018, the company issued 20-year 10% bonds with a face value of $1 million. Now for bonds with similar risk and maturity, the effective yield, also known as the market rate or the yield to maturity, it's 9%. Interest is paid semi-annually on March 31st and September 30th, and the company has a December 31st year end. And it follows IFRS, but we pretty much account for these exactly the same whether it's IFRS or ASPE. So our first requirement is very simple. Without using a calculator, determine whether or not the bond was issued at a premium or discount. Well, as it happens, since the coupon rate of 10% is greater than the market rate of 9%, so the coupon rate, also known as the bond rate, that's the rate of interest that's actually paid by the bond, but the market rate is 9%, so the bond is issued at a premium. And basically, this should make sense because if the company's bond offers a better rate than the market, it commands a higher price. If it was the other way around, if the market rate, the yield to maturity were 9% and the coupon rate were, if the yield to maturity were 10% and the coupon rate was 9%, then it would be issued at a discount because the company's bond would not offer a better rate than the market, and therefore, if the market is better, in order to entice a buyer to buy your bond, you have to offer a discount. So now, what if, right, the coupon rate is 10%? Give an example of the rate, the yield rate that needs to be in order to either have an A premium or B discount. So in order to have a premium, the market rate of interest must be less than 10%. I'll change my color here. So in order to get a premium, the yield must be less than 10%. So you go with 8% or 9 or whatever. And in the second case, in order to have a discount, the yield, of course, must be more than 10%, right? So you can go with 12%. So once you figure that part out, determining whether a bond is issued at a premium or discount becomes really straightforward. Okay, now we get to do the fun stuff. We need to determine the price of the bonds at March 31st, 2018, right? That is the date that the bonds are sold. Well, using your calculator, the first thing you're going to do is put 40N, right? Now, the reason why it's 40N is because this is a semi-annual bond, and so therefore you have to double the number of periods, right? So instead of a 20-year bond, which is what it is, we have 40 payments. Then for interest or IY, you're going to put 4.5, which is half the yield rate. So this 9%, right, needs to be cut in half. So whenever you have semi-annual payments, you double the number of periods, half the rate. If you ever saw a bond that had quarterly payments, which is possible, you would then quadruple the number of periods and then cut the rate in 4. So 40N, 4.5 IY, you can enter 50,000 PMT, right? Now, if you put a negative in front of it, then the answer will pop out as a positive. If you don't put a negative in front of it, just put 50,000 PMT for both the payment and the future value, then the calculator will give you FV with a negative sign or PV with a negative sign, but don't worry about it, just go with absolute values. And that's then calculated as $1 million times 10% times a half, right? So $1 million bonds that pay 10% interest, right? But it's only twice per year. So you have to cut that in half. Then the next step is to put in $1 million FV, right? If you put a negative sign in front of that, then you'll end up with a positive outcome. The important thing to note is that if you're going to use the negative sign, you must do it for both the payment and the future value. Otherwise, your calculator will error out. Then you compute the PV, and you end up with $1,092,008. And again, you can enter the the payment and the future value, PMT and FE, as negative in order to end up with a positive answer, or leave them as positive numbers and interpret the final result as an absolute value. Okay, so our next requirement here is to answer which method to amortize the bond premium or discount is used under IFRS. Well, that's easy. Under IFRS, you can only use the effective rate interest, or the effective interest rate method. That's the only one you can use under IFRS. Under ASPE, you get a policy choice between the straight line method and the effective interest rate method. Pretty much all the work we're going to do is using the effective rate method because it's a little bit more challenging. The straight line method, it takes the premium or discount and simply divides by the number of payments, and that's it. So there's no having to constantly calculate the amortization of the premium or discount, and you actually don't need an amortization table if you use a straight line method. So because effective interest rate is a little tougher, that's the one you should be prepared for. Okay, our next objective here is to prepare an amortization schedule, right, using the effective rate approach up to September 30th, 2019, up to September 30th. So why don't we go ahead and do that? So here is what an amortization table would look like. So you have a column that's for the date. You can have a column for the interest expense, one for the payment. Sometimes you'll see that these two columns can actually be interchanged. I usually put the interest payment first, then the interest expense. Then you have a column for the amortization, and then the unamortized balance of the premium, and then the carrying value of the bond. So the first date is the date the bonds are issued. So March 31st, 2018. You would enter the carrying value in the last column as the PV, and the unamortized balance is simply the amount of the premium. Then, after the first payment on September 30th, 2018, you've got a $50,000 payment. The interest expense is calculated as the carrying value, right, times the interest rate of 4.5%. So if we take this times 4.5%, you will get $49,140. The difference between the payment, right, if we take this 49,140 minus 50,000, I'll put an equal sign there, that's negative 860, right? And so the unamortized balance of the premium is simply 92,008 minus 860, gives it 91,148. The carrying value of the bond is now 1,091,148. The next payment, March 31st, it's still 50,000. In fact, it's 50,000 for all the payments. But now the interest expense of 49,102 is the balance at the end of the previous period. So 1,091 times 1,091,148 times 4.5%. That gives you 49,102. Subtract the amount of payment. The amortization of the premium is 898, giving a balance of premium 90,250 and a bond balance of 1,090,250. And you see how this continues again. For September 30th, $50,000 payment. The interest is 49,061, which is the 1,090,250 times 4.5%. the difference between the payment and the amortization. 49,061 minus 50,000 is 939, gives you a premium balance of 89,311 and a carrying value of the bond of 1,089,311. Here's what the bond looks like in terms of a timeline. It's issued on March 31st, 2018. The first payment, we have, after the first payment, we have a bond value of 109,148. The principal amortization of the premium, the principal of the premium amortization is 860, and the interest 49,140. Then we have an intervening year end. So we're going to have to deal with that a little bit later. The second payment and then the third payment you can see here. So the balance keeps dropping. In fact, what would happen is if we were to set up a T account for the bond payable, right, and we set it up at 109,208, at the end of all the payments, the balance in the bond account would have to be $1 million, because that's the amount that has to be paid back to the bondholder. And it's the series of amortization of the premiums, so 860 and 898 and 939, and that would continue. That's how a T account for the bond payable would look. All right, requirement 6, how much cash will be paid on March 31st, 2019? Well, this might be a trick question because it's so easy. It's actually the interest payment of $50,000. March 31st, and every payment, you have a contractual fixed amount of $50,000. That is the only amount of cash that's actually ever paid. Requirement 7, we're looking at preparing the journal entries for APCO for the period of March 31st, 2018 to December 31st, 2018. So let's begin. We'll use purple now. So on March 31st, 2018, we're going to issue the bond. We will debit cash. The company receives. Remember, we're dealing from the liability side of the balance sheet in this course. So you are the company or Abe is the company that's issuing the bond. It receives the cash. So it receives a present value of 109,208. We will then credit the bond payable for $1 million, and then credit the premium on the bond payable for the amount of the premium. Alternatively, you can also use a single account for just the bond and not keep track of the premium or discount separately. So the method shown here in this solution uses a separate account for the premium or discount, but in many other problems you'll see I just use a single amount or a single account and don't keep track of the premium or discount separately. So you would debit cash, basically credit the bond payable both for $1,092,000. So if we kept track of the T account for the premium, we have a credit balance, right? Because the premium adds to it, right? So if we have a bond payable value of $1 million, then the premium must also be a credit balance, so they add up to $1,092,000. If you use a single bond payable T account approach, then basically you have a T account with a carrying value of 109,208. Then on September 18th, after the first payment, we're going to debit the interest expense for $49,140, credit cash for $50,000, and then debit the premium on the bond or the bond payable account if you use a single account for $860. So you can save yourself the math of the premium amortization if you're not asked to do an amortization table. You know, the interest expense is the balance times 4.5%, and the $50,000 is the cash payment. So the difference between the two is going to be $860, and in order to plug the journal entry, it has to be a debit. And you can see what happens here is we then enter this as a debit on the premium, And now we end up with a balance of $1,091,148. If we were to do a single T account, then this premium would just be a debit in the bond payable T account, just like it is in the premium account here. Okay. Now is our intervening year end, right? Our pesky year end. So in this case, right, we're going to debit interest expense, but only for 1/2, right, or 3 months out of 6, because you always have to count how many months have transpired. So from the last payment at September 30th, there are 3 months left, October, November, and December. So that's where the 3 months comes from out of the 6 months. So the next interest expense would be $49,102, right? So we cut that in half. So we'll debit interest expense $24,551. We'll credit interest payable, right? We're not crediting cash yet because it's not paid until the cash is actually paid. So we set up an interest payable, which will be the $50,000 cash payment times 3/6, and then you can plug the remaining debit to the bond payable premium account for $449. And that's what it looks like here. We'll put a credit in the premium T account, and now the balance in the bond is $1,090,699. In terms of what our financial statements would look like at the end of the year, will be presented on the income statement at December 31st, 2018, and the balance sheet. Well, here's what we've got. Change pens. So for the income statement, we're going to have the interest expense of $49,140, right? That was the first interest payment, so payment 1. And then $24,551, which is the year-end accrual. So the total interest on the income statement is $73,691. Then, for a balance sheet, we have an interest payable of $25,000 and the balance in the bond payable account of $1,090,699. And that takes care of that requirement. Okay, so now on March 31st, 2019, 1/3 of the bonds were called by APCO at a price of 105, and we have to prepare the journal entries on March 31st, 2019. So let's go ahead and do that. Change the color of the pen. So first step is to update the amortization up to the date of acquisition. So on March 31st, that happens to be 3 full months, January, February, March, after the year end. So we're going to debit interest expense for the remaining $24,551. So that's the unaccrued portion of the interest expense. So at December 31st, we accrued $24,551. And now we're expensing the other $24,551, so $49,102 times 3/6. We are going to debit the premium on bond payable for the other $449, or the other 3 out of 6 months of the premium amortization of $898. We will debit interest payable. We already set that up for $25,000, so we have to credit it, and all those will add up to the amount of cash that has to be paid of $50,000. So they're paid out, right? And then in the premium T account here, we have the other $449, giving us a balance now in the premium of $90,250, and the carrying value of the entire bond, $1,090,250. The next step is to record the reacquisition. So the company calls the bonds, it means it's going to buy them back. So the company is reacquiring 1/3 of the bonds. So we have a balance in the bond premium payable account right now of $90,250, right? Well, we're going to remove 1/3 of that balance. So we're going to debit the premium on the bond for 1/3 of $90,250, or $30,083. So that's what this debit to the premium on the bond account is. or if you use a single T account for the bond payable, it'll still be the same amount. It'll just be in one T account. Then we're going to remove 1/3 of the bonds. So we have a debit to bond payable for 1/3 of $1 million, $333,333. So if we keep a T account for the bond payable, here is a debit, $33,333. The company is going to pay, right, $350,000. How's that calculated? Well, you see this little pesky 105? This means whenever you see 105, that means 105% of its face value, or 1.05. If the bonds were called at 98, that would be 98% of face value, or 0.98. So in this case, $1 million in bonds times 1/3 being reacquired at 105 is $350,000. So credit cash $350. Then in order to make our journal entry balance, right, our debits have to equal credits, we need an additional $13,417 credit. Well, that will be a gain on reacquisition. So basically just plug the journal entry to make a balance. If you needed more debits, right, then you would have a debit, which would be a loss on the reacquisition of bonds. Here's a proof of the gain on reacquisition. So the carrying value of the bond payable at March 31st is $1,090,250, right? 1/3 of that is being removed, so $363,417 would be 1/3 of the balance. Here, save this, $1,090,250. 1/3 that's being removed. The cash paid is $350,000, which means the difference between the amount that's removed and the amount that's paid is $13,417. Now we need to prepare the journal entries at the year end, which is December 31st, 2019. So we go just one more period here. Now at this point, 2/3 of the bonds are left. We got rid of 1/3, so we have to take anything that's left and multiply by 2/3. On September 30th, we're going to debit interest expense for $32,707. How do we know this? Well, since we already have our amortization table that we prepared earlier, we know the next payment has interest expense of $49,061. But 1/3 of those were required, leaving 2/3. So the interest expense is just $32,707. You can leave a space for the premium of the bond and credit cash immediately for $33.33, which is 2/3 of the continuing interest payment of $50,000, right? And then just plug the journal entry for the rest of $626, which happens to be $939,000 premium amortization times 2/3. Again, if we use a single account, then we would just have a debit to the bond payable rather than a premium of bond payable. And then here's what it all looks like. So all the way to the end, the premium on the bond started at $92,008. We had a payment, we had a year end, we had the second payment, then we had a reacquisition, and then the next payment, the third payment, leaving a balance of $59,541 on the premium. The bond payable really sits at $1 million until this 1/3 reacquisition, leaving $66,000. So the balance in the bond, when all said and done, at September 30th, 2019, is $726,207, or $1,089,311 times 2/3. Okay, so now we proceed with extra problem 2. I am finished. It's a small company that follows ASPE and uses the straight line method of amortizing all outstanding bonds. It has a December 31st year end and will issue bonds as a source of financing and release it. So basically it has 2 bond offerings. So the first bond offering, right, are 10% bonds on January 1st, 2018. 10% $1 million bonds at a price of 104, and they mature on January 1st, 2038. Interest is paid each June 30th and December 31st. And on July 1st, 20% of those bonds were redeemed for a price of 101. Second bond offering, they're 14% bonds on April 1st, 2019. No joke. They issued 14%, 2 million bonds at a price of 96. So the first one are issued at a premium, the second at a discount, right? Because we know that at a price of 104, that's more than the bonds are worth. So that means a premium. Here, a discount. In the second offering here, they're due April 1st, 2039. Interest is paid each March 31st and September 30th. So this was a bit of a dog's breakfast. Our requirements. For both bond issues, we're going to have to prepare all the journal entries from January 1st, 2018 to December 31st, 2019. We were going to have to show what amounts we'll see on the income statement for the years ending December 31st, 2018 and 2019. And then we will show the amounts on the balance sheet at December 31st, 2018 and 2019 with proper classification. Okay, here's what this bad boy looks like. On January 1st, 2018, the bond is issued. There's a payment on January 1st, on June 30th, 2018 on the first bond. Then there's a second payment and a year end. Those are all for the 10% bonds. Then we truck along on April 1st for the 14% bonds are issued. And then nothing happens for that bond until September 30th, 2019. But in between there, on June 30th, 2019, we have the third payment on the 10% bond. Then on July 1st, the day after, we call 20% of those bonds. And then we have a year end at December 31st. On the 14% bonds, after the payment, we also have a year end on December 31st, and then there'll be another payment on March 31st. But we only have to do our journal entries here up to December 31st. So for the 10% bonds on the first issue, we're going to debit cash of $1 million at 104 because the company sold them at 104. So debit cash for $1,040,000. We will credit bond payable of $1 million, and then or you can credit the bond payable for $1,040,000, and then you don't have to keep track of a separate premium. Or if you want to go with $1 million in the bond payable, we just put the difference of $40,000 to the premium on the bond. And it's okay. So now on June 30th, 2018, we have our first interest payment, but notice that we did not create a bond amortization table. Remember, this is an ASPE problem, and we are using the straight line method. So even though we're going to have a debit to interest expense, I want you to save the amount until the last piece. So put a placeholder, debit your interest expense. We're going to debit the premium on the bond, right? Because we have to slowly amortize the premium down to zero. We set it up as a credit, so we'll need a series of debits. And then we're going to have the cash payment. So credit cash first. So $1 million times 10% times 6 over 12, it's 50,000. Credit cash 50,000. Now, because the premium is 40,000, we're going to straight line amortize that over 40 periods. So that's $1,000 in bond amortization, bond premium amortization per period. So debit the premium or the bond payable account if you use a single account for $1,000. Then you can plug the interest expense to be 49,000 or 50,000 minus 1,000. So the catch is here, do the cash first, take the premium on the bond and divide by the number of periods. So here's that $40,000 premium, right? And we're dividing it by 40 periods. So the interest expense is actually the last part of the entry because it's the difference between the cash and the amount of the amortization. In the effective interest rate approach, the interest expense is the first item that you include. Then at December 31st, just prior to your year end, here the payment and the year end are the same date, but we always do the normal transactions first and then any adjustments. But look at this, it's exactly the same as the previous entry. So every single payment will look exactly the same. We're going to debit interest expense for $49,000. We're going to debit the premium on the bond for $1,000 and credit cash for $50,000. Because we're taking this $40,000 premium and amortizing it evenly, each number still is this, each amount of premium amortization is exactly the same payment after payment. So the journal entries are identical throughout. Unless the company reacquires some bonds, that's the only time you're going to see a change. So now at year end, there's nothing to do on this particular bond. So we go through the year end, but because the interest payment is also at December 31st, there's no accrual necessary. So the red line here just represents that there's a year end and now we go past it. So our next date would be April 1st, but there's no transaction related to the bond on April 1st. It's on April 1st that the new bond is issued. So now we have the second bond. We go through a similar process. We're going to debit cash for the amount. This time these 14% bonds, there's $2 million of them. So $2 million at 96. This is a discount. So we're going to debit cash $1,920,000. We're going to credit the bond payable for $2 million and now set up a discount on bond payable account that has a debit balance of $80,000. Or if you use a single account, just debit cash $1,920,000, credit the bond payable $1,920,000, and you don't need to keep track of the discount separately. The next chronological event would be the June 30th. So here we go with this 10% bonds. We've issued them. We've had the first payment, the second payment at the year end. We are here right now, June 30th. And guess what? The entry is exactly the same as it was for the other two. Debit interest expense, $49,000. Debit premium, $1,000. Credit cash, $50,000. No problem. But then, now we called 20% of the bonds. Okay, now this, what's in this box here looks a little complicated, but it's not too bad. Take it one step at a time. The company is calling 20% of the bonds. So as it stands now, the balance in the bond premium payable account, you can keep a T account for it, but you don't have to because you can just look at how many amortization periods have occurred. So the balance in the bond premium would be $40,000 minus, so $40,000 the original balance, minus 3 payments or 3 amortizations of $1,000. So 40,000 minus 3 is 37,000. 37,000 times 20% is 7,400. Okay. So debit the premium, 7,400. Debit the bond payable. This one's easy. There's always $1 million in the bond payable if you use this approach. If you used the combined approach, then you could do this in one entry. The balance in the bond would be $1,037,000, and then you multiply that by 20%, and you would have $207,400. Nevertheless, we're using a separated approach. So you're going to debit the bond payable for 20% of $1 million. You're going to credit cash for $1 million times 20% that are called at 101, so 202,000. And then because your debits must equal credits, we need a credit in this case of 5,400 to make the journal entry balance. Right? Don't ever have to worry about actually calculating the 5,400 unless you're asked to. Just leave it as the last item in your journal entry and then plug it. So now because it's a credit to make it work, we're going to have a gain on the call or reacquisition of the bond, 5,400. That's it. If you wanted to have a proof for it, the carrying value of the bond is, as I said, if we use a single approach, would be the $1 million plus the remaining premium of 37,000. So 1,037,000 times 20% is 207,400, but the company is paying 202,000, so that means that there is a gain of $5,400. Right? It's paying less. It's paying 202,000 for a balance on the paper that's worth 207,000. Now for the 14% bond, right? We've already been through the issue, so we are here right now with the September 30th payment. This one's a very simple item. So in your journal entries, create a line, so debit interest expense, but leave it, right? Credit discount on bond, right? So what we do when we're amortizing premiums, we debit. When we're amortizing discounts, we credit, and then have a credit to cash, right? Do cash first. Cash, $2 million that pay 14% semi-annually. So 2 million times 14% times 6 over 12 is a credit to cash of 140,000. The amount of the discount that's being amortized, right, based on the original issue, the bond discount was 80,000. It's a 20-year bond paying semi-annual, so it's 40 payment terms, which means that the discount is 2,000. So 140 plus 2 is 142,000. To make the journal entry balance, we need a debit of 142,000, and that journal entry is taken care of. Now at the year end, December 31st, 2019, we have the last payment for the $10,000 bonds. Remember, what's left is there are 37 payments remaining. So as with the other entries, we'll set up a debit to interest expense, set up a debit to premium on bond, and credit cash. We know that the cash is going to be, in this case, the original $1 million times the 80% that were remaining. Remember, 20% were called. That leaves 80%. That's what this is. They pay 10% semi-annually, so credit cash 400,000. 20% of the bonds are left, right? So we had the original $40,000 premium minus $3,000 in total amortization, minus $7,400 that was removed on the call, right? So divide that by 37 periods. So 40,000 minus 3,000 minus 7,400 is 29,600. So 29,600 divided by 37. Do this right, is $800. So debit the premium, 800, and then plug the interest expense to be 39,200, or the original 50,000, right? If you want to go back to the original, there is 50,000 minus the normal $1,000 in premium amortization. That's where this 49 comes from to get you 80% times 80% gives you 39,200. Then on the 14% bond, we have to accrue at the end of the year. So set up the same accounts: debit interest expense, credit discount, credit interest payable. Do the interest payable first because it's the easiest. There's $2 million in bonds that pay 14%, but this time they're 3 months. 3 months out of 12. That gives you interest payable 70,000. The discount on bond is the 80,000 in total bond discount divided by 40 periods. But we're only multiplying by 3 out of 6 because there's 6 months left until 6 months between the payments. So we're halfway between now and the next payment. So we're going to credit the discount for $1,000. And to make your journal entry balance, we will plug or debit interest expense for $71,000. Our next requirement is to show what the income statement presentation would look like for the years ending December 31st, 2018 and 2019. Let's just start with 2018. So in 2018, the only bond we have is the 10% bond, right? We didn't issue the other bonds until the year after. So as we did with the previous problem, for the period from January to June, their full 6 months of interest at $49,000, and then another full 6 months of interest expense at $49,000 from July 1st to December 31st. So our income statement is going to show $98,000 in interest expense. If we look forward to the next year, in this case, for the periods of the first 6 months, right, you're going to have $49,000 in interest, and then from the period of July 1st to December 31st, $39,200 for a total of $88,200. For the 14% bond, again, because it wasn't issued until 2019, it was only issued on April 1st. So between January 1st and March 31st, there's nothing. From April 1st, when it was issued, to the first payment, a full $142,000 in interest expense, and then from October 1st to December 31st, there's $71,000 in interest expense for a total of $213,000. So for 2019, the total interest expense on the income statement is $301,200 between the 10% bond and the 14% bond. And there's a gain on redemption of bonds of $5,400. Remember, those the 10% bonds were 20% of them were called, and we had a gain on redemption of $5,400. The last requirement is the balance sheet. We'll go with 2018, again, only on the 14% bonds. There's nothing, no interest payable on the bonds, because the interest payment dates are at June 30th and December 31st, so we never have to set up an interest payable. We do have a non-current liability, though, and it would be reported 10% bonds payable at a premium, and the amount of the premium that remains, or the total of value of the bond that's being carried, is $1,038,000, which would be the $1,040,000, the beginning carrying value, minus 2 periods at $1,000. So $2,000 have been of the premium discount have been amortized, giving you $1,038,000. For the 14% bonds, remember there is an intervening year end because the payment dates do not fall at the middle and the end of the year nicely. So there's interest payable at the end of 2019 of $70,000, and we would have 14% bonds payable of $1,923,000. So that concludes this Chapter 14 video tutorial on bonds. I hope you found it useful.